Just very different. How different are my kids? They are. Okay. Yeah.
So we
One is the most chill pig you'd ever seen in your life, and the other one's a terrorist.
US.
Yeah.
It's
Yeah.
funny.
Fair warning though, you have the terrorists first.
Sounds like-
It was like, you did so well.
Yeah.
It's around.
That's the best one.
If we're on time, then
Alrighty, can I just get one online to let me know if they can hear us?
Social.
Yes, loud and clear, Matt.
Okay, no problems.
Still not working.
Oh, really?
Will be no.
Alrighty, I'll throw over to Liv again for an introduction to session 2. For those in the room, please check in by the QRs, and those online, no stress.
And thanks, Matt. So really excited to have Julian Campbellwood here for the next 45 minutes or so. Julian's one of the 4 portfolio managers for Resolution Capital for their global property securities fund. That's a best of breed, high quality portfolio of global REITs and real assets. I know some of you in the team are very familiar with Resolution Capital. Others might not be familiar at all. So I think Julian will give a bit of an introduction to Resolution Capital as a business, their philosophy, how they construct portfolios, and then maybe a bit of an update on the global REIT market. But please feel free to jump in at any time with any questions that you have. With that, I might hand it over to you, Julian.
Thanks, Liv. Hey, everyone. I think that's a good framework for discussion, but very much happy to take it in any direction. So feel free to ask questions along the way. And in addition to what Liv said, we'll maybe look at 1 or 2 examples in the portfolio, just sort of bring some of the investments to life, a little bit different to what's around in the Australian market. In terms of Resolution Capital, we're a listed global real assets manager. And the history of the business is really managing Australian REIT securities. So the core of the team, Andrew and Marco, did an MBO out of Lend-Lease, and that was the formation of Resolution Capital back in 2004. Andrew's been managing A-REIT securities for over 25 years. And as a business now, we've been managing global REIT securities since 2006. So one of the longer track records in the Australian market for managing A-REITs and global REITs. And more recently, 5 years ago, we expanded that capability into listed infrastructure. And that provides both a blended A-REIT and infrastructure product for Australian-based investors. And also 4 years ago, we launched a global listed infrastructure fund. But still, core of the business, as you can see there, very much in global REITs. But to give you a bit more background in terms of the team and the way that we're set up, the majority of the team is based in Sydney, and that's very much by design. We do have 2 of the global REIT team based in the US. Rob Fromicel, one of the other global REIT portfolio managers, is based in New York, and he has an analyst in the US working with him. The rest of the team is based in Sydney. And for us, it's an important part of constructing a concentrated global portfolio. And you'll see when we dig into the portfolio, we have 45 investments around the world. The challenge often for investing in global REITs is that different regions look at things slightly differently, whether it's valuation conventions, accounting conventions. So for us, it's important to harmonise that universe so that we can look at our investments on a consistent basis. And doing that for the team in one location, we find to be far more efficient and effective than having regional-based teams. And you will see some invest in global listed real estate. We'll have a US team, have a UK team, European team, an Asian team. And the client portfolio is really the roll-up of those sub-portfolios. But for us, one team, location, and that helps us in terms of creating that concentrated portfolio. In terms of the way we do things somewhat differently to our peers, firstly, we have one global REIT strategy. You might find other managers that have numerous customizations. In essence, we have a concentrated portfolio. What we think is some of the best real estate that you can invest in, public or privately. And we'll dig into some of the quality you can get in the global listed REIT market. We say that it's less than 60 stocks. Since the inception of the strategy, it's been 45. There's one that we're aware of, or there's more concentrated than us, but by and large, it's one of the more concentrated global listed portfolios. And we research by property sector. Why is that relevant? Well, when you think about a lot of the things that are driving real estate markets around the world, many of them you'd be able to name yourself, whether it's work from home, e-commerce, digitization, the explosion in AI, aging demographics. These are very much global themes, and they're impacting real estate markets around the world with local market nuance, but the trends are very much global in nature. So what we're looking for is to identify those secular themes which we believe will drive real estate returns over a multi-year period, and then how we can invest in those in the different regions that we're investing in. So we're not a top-down geographic type investor. It's not like we're going to invest X in the US, we're going to underweight here. Regional exposure to us is very much bottom up. So where are we finding the best pricing power, risk-adjusted returns at the individual portfolio level? And then obviously overlaying macro dynamics. When we look at the portfolio construction, you'll see how that's been expressed more recently. So it is very much a portfolio which we deem to be really high quality listed real estate. So it's all public securities listed on the stock exchanges around the world, and done so very much with a bottom-up sector-driven focus. The way we execute that in terms of portfolio management, again, is we think a competitive advantage and different for many, and that's the multi-portfolio manager approach. And in simple terms, that means there are 4 of us managing the portfolio, which I'm one. Andrew, if we've got our mugshots here on the next slide. Awesome. There we are. Andrew Parsons, founder and CIO on the left. Marco Colantonio, also founder. Rob Promisel has been with the business since 2011, and then I've been with the business since 2013. But what it means is each of us manage an individual portfolio, and the client's portfolio is the consolidation of those 4. We each invest across all regions and sectors, and we do so on a fully open book, transparent basis. So why do we do it this way, and what do we think the advantages are? One, it removes key man risk. And when you've seen some other star portfolio managers in Australia in equities stumble, ultimately there are often changes within PM lineups. And when you've got a deeper bench, if someone leaves, you've got 3 other PMs managing the portfolio. So we think it creates resilience because there is inevitable change. In the 18 years, 19 years that the global portfolio has been run, there has been a couple of changes for PMs. One sadly passed away. More recently, Jan de Vos moved across to lead our infrastructure business. But ultimately, the client hasn't seen any change in the way the portfolio has been managed because you have the other PMs there. So it creates style consistency and redundancy in the team, which we think is important for longer term investing. It also creates a framework for conviction testing and peer review. So as I said, some within our space will have a US team, a European team, an Asian team, and it means you might have PMs who aren't across the whole portfolio or all sectors. So in this, each of us invests across all regions and all property sectors, and we can have a detailed debate and discussion about anything in the portfolio. Hopefully, we believe it creates a better investment decision at the end. And for us, it is all about the ultimate client portfolio. We're all invested in that. The majority of our compensation is all on the ultimate client outcome. But we do think it's a good framework to help reduce key man risk, create consistency, and hopefully lead to better long-term consistent performance. Any questions on that one? I know it can be a little bit different, but
Is it working?
yeah.
Oh, no, that's all right.
So that's the broad tenets of how we've set up the business, and then moving to philosophy and how we think about investing in listed real estate. And for us and our clients, we always just say you're investing in real estate. It really is about a liquid and transparent way to get access to really high quality commercial real estate in major markets around the world. So it provides your clients diversification from Australia. At the moment, 5 to 6% of the portfolio is in Australia. 55, a little under 55% is in the US. At the moment, about 10, 11% in the UK, 12% in Europe, and then the rest in Japan, Hong Kong, Singapore, and Australia. So global diversification, yes, it is US heavy, as many global portfolios are at the moment. And that's reflected both the opportunity set. So when we look at the different property types, there is a real depth of listed real estate in the US across a vast array of property types. And we will move that around depending on opportunities. So at the moment, we're actually materially underweight the US. And again, that's bottom-up driven relative value. And we're overweight the UK and Europe, where we're seeing better relative value. And we'll expand on that. But it is very much a real estate investment. So you can think about it as a 5 to 7 year holding period. And it is about finding high quality real estate with pricing power. So where the landlords have the ability to drive rents and cash flow, and that's ultimately what supports your total returns over time. It's very much about that recurring cash flow, dividend growth, and underlying compound growth in value.
Sure. It's a good question. You mentioned 15% in Japan.
No, at the moment it's about 6.
Oh, you 6%. Is that because it is a shrinking population because in value?
Yeah.
Are you strategically looking to exit that position as well, or?
No, it's a very fair question. It is very much a Tokyo portfolio. So the majority of the investments we have, which is 2 Japanese investment companies, is predominantly Tokyo. Tokyo's population still is growing because you've got some urbanisation, but you're on longer term. There are some question marks there. Japan's been an interesting one for us in that it had been valued for a long point in time and just sort of languished. But you've really seen a step change in terms of activity. We've seen it in rental growth. And the predominant exposure we have there is office, and actually vacancies 2%. So big picture, longer term, yeah, question marks at the moment. Pretty attractive dynamics, very low real interest rates, rental growth returning, and inflation returning to that market after several decades. So it's actually been a pretty healthy market in the near term. Now, will it be the case in 10 years? Perhaps not. But again, for us at the moment, we see attractive relative returns there, still reasonably priced for what we can get. And for us as a listed investor, should our view change, we can transition that capital out relatively quickly. In terms of the financial side, really for us, there's a couple of key tenets, and that is trying to minimise permanent capital impairment. And what that means is simply having too much debt at the wrong point of a real estate cycle, and then your underlying returns are impacted by the need to raise equity. Think about A-REITs during the GFC, pretty horrible returns for many investors. It was the same in the UK. So we typically have pretty modest leverage. So the portfolio is about 30% loan to value at the moment. And that's on values, which in most markets are down 15 to 20% after the recent repricing, given the move higher in interest rates. Very different often than what you find in private markets. If you look at CMBS leverage in the US, it's in the mid-50s. If you look at some syndicates, they can be in that level as well. So that can create some pressure as you go through the value cycle. So low leverage for us, minimising permanent capital impairment. And the way that's been expressed in terms of portfolio returns is the strategy is typically done well during correction periods. So GFC, start of COVID, were points of substantial alpha. And it's not to say it doesn't perform in rising markets as well. It does. But we do have that focus on conservative capital structures, which does help some of that resilience during cyclical periods. We're also focused on the sustainability of distributions. So this isn't a yield product. It's not an 8% total return. It's about a 4% dividend yield. And it's about that growth in cash flow and compounding value over time. But we want that to be sustainable. At the moment, the payout ratios are some of the lowest they have been for a long period of time. The last and critical as minority investors in these portfolios is alignment. And this is true for any equity portfolio. You want the people running the business or the portfolio to be as aligned as possible. The way this is somewhat different in real estate is we typically screen out externally managed REITs. So in Australia, you might be familiar with things like Charter Hall Retail, Charter Hall Long WALE. In Asia, there are a lot of externally managed REITs. we don't think they are the best aligned structure for long-term returns because the manager's paid on AUM rather than per share value creation over time. Now, there's obviously a range of that. There are some good external managers, some less good ones, but for us, when we can invest in an internally managed REIT, so where the company is part of the portfolio, that to us is a greater alignment and tends to mean better long-term returns. So pricing power, quality real estate, looking for where we can find supply constraints or low supply, focus on recurring cash flows, low leverage, sustainable distributions, and focus on alignment. So minimising that permanent impairment of capital. In terms of accessing the strategy, the hedged product is available on the ASX. So that's the global hedged strategy. It is the same as if you want to go through the traditional unlisted fund approach. You can also get it in unhedged as well, but not on the ASX. And on the right is the hedged active ETF for our infrastructure product. Pleased to have good support from the major rating houses, which has been sustained for quite some period. Now, what I might do is just jump here to give you a snapshot of what actually is in the portfolio, what clients are getting exposure to, because it's a little bit different to what is available in Australia, and often quite different to what people think about in terms of commercial real estate if they're less familiar with the sector. So the advantage of global, one, the diversification by region we touched on, but also the diversification by property sector. So it's less about your traditional office, retail, industrial, but a lot more diversity in terms of the alternative sectors. So for us, healthcare real estate is one of the larger positions and active positions in the portfolio, as are data centres and cell towers, but then others there such as residential self-storage and retail. To expand on the healthcare and residential, because they are a little bit different to Australia, healthcare is predominantly in the investments that we have rental seniors housing. So it's a simple private pay model. Resident moves in, pays rent during their stay, which is typically 2 to 3 years, and they pay for their care. So it's very different to Australia where you've got the different federal funding models. So it's private pay and you don't have that stroke of the pen risk. It's very much about the resident moving in and paying for themselves. And in the US at the moment, given some of the policy volatility, that's quite important as well. It is also somewhat different in that for some of those portfolios, you're exposed to the underlying operations of the business. So it's not a lease. You're exposed to the EBITDA of the seniors housing facility, which at the moment is fantastic because it's growing at 20% per annum. It won't always do that, but that has been a key part of the investment thesis around healthcare real estate. And it also tends to be less economically sensitive. So if there is a downturn in the US, these income streams tend to be relatively insulated. There are also a few other things with healthcare, outpatient medical. We're not in hospitals. Again, Australia's obviously had some challenges with hospitals. So for us, it's outpatient medical, seniors housing predominantly, and a little bit of life science. In terms of residential, differences again for Australian investors, this is true cash flow, as in there's 6% yields growing at the moment, anywhere from 2 to 5%. So unlike Australia, which is tilted more to long-term capital growth, it is very much a cash flowing investment. And it is rental apartments, single-family homes, manufactured housing estates. So if you're familiar with Ingenia, Lifestyle, these are larger facilities that have been around for decades. It's a much more established market in the US than Australia, but similar model, great cash flow, and some student accommodation. Predominantly the residential is in the US, but also Canada, a little bit in Germany, and student accommodation in the UK. Data centers, which we'll expand on, very topical area of the investment landscape across equities, private, public data centers. Obviously, NVIDIA reported this week, managed to hold its share price, which after rising 86% since April was probably a reasonable outcome. But for us, we've been investing in data centers for a decade. So it's been less about this supercharged AI thematic over the last 2 to 3 years. It have been, for us, about the digitization of the economy. So enterprises moving their workload into the data centers, out of the on-premise environment. So, business like Pinnacle would have perhaps had a larger server room. Now you're seeing businesses similar to ours. You move it into the data center, better access. You'll connect to your SaaS platforms, your network providers, your cloud providers, and that continues. There's still years of runway for that underlying demand to grow, but clearly the last 3 years has been all about AI, and there's two positions in the portfolio. Digital Realty is more exposed to that AI build out. Equinix has been more driven by the retail co-location type model, similar to what I articulated there. So it is it's a good exposure to have from NextDC here in Australia. For those of you following Australia, it's just reported. Last I looked, the stock was up 18%. So it is starting to see that flow through of hyperscale demand come to Australia, and that's starting to flow through to its business as well. So that's a quick snapshot. We do have also office real estate in the portfolio. It's about 7%. Logistics about 6%, and we can look at the active and relative positions there as well and dive into a little bit of the thesis behind that. This gives you a snapshot of how the REIT sector has changed. This is the opportunity set. So the blue bars being in 2007 and the red bars where it stands today. So much greater diversification, much greater exposure for your clients to alternative sectors. So it's not just office, retail, and diversified. It is very much a broader exposure to areas where you have some of those longer term themes. That being said, we're actually pretty positive on retail at the moment. It is one of the larger positions in the portfolio. If you've seen some of the Australian retail results recently, Scentre Group and Vicinity are 99.5% occupied. That's sort of landlord nirvana, and strong rental growth, performing quite well. The mall positions we have in Europe, similarly, even though the European macros may be not as dynamic as Australia, those portfolios performing very well. And even in the US, where you've got tariff issues and you're not quite sure what's going on week to week, the mall portfolios are also performing well. So retail has really come back, and there's pockets of strength coming through in the office markets as well. Now, to returns for real estate. What we're highlighting here is it is very much an underlying real estate investment. And the last 5 years have been a pretty underwhelming period for real estate returns, whether it's been direct, listed, and this has been global. So whether it's large sovereign wealth funds, institutional funds here in Australia, the returns have been flat at best, and some have been below, and that's over a 5 to 7 year period. Now, this is the US just because we've got better data to be able to show this, but REITs have provided competitive returns over that period, but it has been a pretty muted period. When you think about the return profile, it is a combination of the bond with cash flow growth. So you've got that dividend and the growth and compounding value over time. But clearly with the step change in interest rates in the last few years, that has impacted real estate values. But as we'll touch on, we'll see that we're largely through that now. And if you look at the major markets around the world that we're invested in, whether it's US, UK, Europe, Australia, values have bottomed and are now starting to inflect higher. And that's initially driven by rental growth, but clearly interest rates in many markets are becoming more supportive. Short-term rates have been cut in the UK, Europe, increasingly expectations of that in the US and Australia. And that's helping move the cycle into its next phase. Values are bottom, rents are growing, and you're starting to see that improvement in transaction activity as investors have improved confidence in their ability to underwrite returns. So we've been through a pretty challenging 5 year period, although when you compare it to prior cycles, and the GFC values fell significantly more. That's because you had pressure on rents. This cycle has just been an adjustment in interest rates and discount rates, and rents for most sectors. There are exemptions have generally grown through that period. So it's been a more modest adjustment than you've had in prior periods. But the sector is largely through that. Values are inflecting, rents are growing, transaction market is starting to pick up. So it very much is looking to that next cycle, next phase of the cycle rather. And what we see as favourable for real estate, ultimately, it's driven by demand and supply. It is as simple as that. The execution of that is not as straightforward, but when we look at the cycle over the next 3 to 5 years, we're looking at a phase where supply has come down fairly meaningfully in many property types. And supply is just the delivery of new buildings. So how much new construction is there? And that's what will impact landlord pricing power. So the ability to grow rents. In the short term, yes, the REIT sector is obviously exposed to interest rates, but I can tell you supply will trump that. And if you look at the UK, for example, UK mall values fell 60% during a period where interest rates were being cut all the way through, just because you had a fundamental oversupply of space. So yes, in the short term, interest rates are clearly supportive around discount rates, but the returns over a multi-year period will be driven by those supply constraints, pricing power, and also replacement costs, which we'll come to. So the supply is coming down, and that will help to underpin returns over the next 3 to 5 years. And the reason supply is coming down is because it is quite expensive to build. The inflation that we've all experienced over the last 4 years, construction costs are up anywhere from 20 to 40%. And that's also in an environment where values have come down 15 to 20%. So the cost to deliver buildings has increased fairly substantially, and that's what we're showing you here in terms of the red line, and that's replacement costs as assessed by the insurer Zurich in the US. So what's the cost of building a new building? And that helps inform their insurance decisions, but for us, it's an indicator of construction costs and property prices. So it gives you a snapshot, and it's not that development's going to zero, clearly it doesn't, but it is moderating, and for certain sectors, it is still uneconomic. Some areas it's hugely profitable, data centers, people tripping over themselves to build them because they're trading at 2 times replacement cost. And other sectors such as seniors housing in the US, where we've got material investments, assets are still trading below replacement costs and development has collapsed. We'll look at some slides on that. So high cost of construction, values adjusted, supply is coming down. And that should be reflected in growing rents and bottom line earnings. And this is our resolution universe, which is our primary universe of 150 real estate portfolios around the world. And that 150 securities has all been had an initiation report, is approved by the 4 PMs as investment grade. And that means that's the palette of opportunities with which the individual PMs can construct their portfolios. Here, just highlighting that over the next few years, earnings growth is accelerating for the sector. And the portfolio, which is a subsector of this, is actually growing faster than that because we have greater exposure to things like healthcare and data centers, which are generating higher growth. But importantly, earnings are on an upward trend. We look at that through time. Clearly, the market focus is very much on tech, AI, and there's echoes of 2001 there in terms of the enthusiasm and capital chasing that sector. But when you look at the profile of REITs, being the blue line, it is pretty consistent outside of the GFC type COVID periods. You have that consistency of earnings growth, and that's given the lease structures which help to underpin that. You're never going to get the turbocharged growth that you're getting out of tech, but it is resilient growth and more consistent. We think the sector's pretty well positioned to deliver that, particularly given the starting multiple. Now, equities is just one benchmark when we look very much at replacement costs, the bottom up value and IRRs. This is over the 20-year history of the strategy. So blue being global REITs, red being equities. Clearly, we're in a period where global equities have relatively full multiples. And we're not here to say when that may correct, but as you can see, over 20 years, they tend to converge. And we think that the REITs, given the fundamentals of the sector and at a reasonable starting multiple, offer reasonable diversification in clients' portfolios and a reasonable return outlook. So 4% dividend yield, earnings growing at 4 to 5% on an average long-term multiple, supply falling and replacement costs high. Now, another value indicator is price to net asset value. Simply, that's looking at the share prices of the REITs and the underlying value of their portfolios. And this is a global long-term chart, about a 15% discount, which is not by any means a deep discount that you get in the depths of COVID or the GFC, but it's on values that have already corrected anywhere from 15 to 20%. And that means those NAVs have corrected 20 to 30 because that's a levered number. So discounts on values that have already corrected and have now started to inflect. We're seeing, as you do in these cycles, if there is perpetual discounts, you start to see private equity, Blackstones, KKRs, etc., start to arbitrage that. And we've seen quite a lot of that in the UK recently in terms of M&A into privatisations. And we expect that will continue. If you've tracked Blackstone or any of these big funds, they've got significant pools of private capital, and they will continue to deploy, unfortunately, our poor sector. To capital structures, this gives you a snapshot. Here it's debt to EBITDA, which can be a little difficult to picture, but the chart on the left just gives you some historic context, both in terms of net leverage, so that's just your LTV, loan to value, how much debt you got versus your assets, and debt to EBITDA is just a cash flow measure, but significantly lower leverage than the sector's had at prior points in the cycle, and that again helps with the resilience of that return profile. For ResCap portfolio, about 6.5 times, about 30% loan to value. Australia looks quite low there, and that's Australia balance sheets are in pretty good shape. It's also tilted lower by things like Goodman. They don't have any debt on the balance sheet, on the headstock anyway. Now, moving into a couple of examples, and Welltower is a US listed healthcare REIT. It is the largest position in the portfolio. It's about 8.5%, so a pretty substantial position. And it is also the largest REIT, 125 billion enterprise value. So what Welltower does is seniors housing, which we touched on at the start in terms of rental seniors housing, and that's a mix of the operating seniors housing that I mentioned, where you're exposed to the EBITDA, but also some leased seniors housing. That is the core of our thesis for this investment. Another one, Ventas, which is about 5.5% of the portfolio. It really is that seniors housing piece. That being said, outpatient medical is also performing pretty well. Outpatient medical, to picture it for you, think about buildings which are sometimes on hospital campuses or adjacent, where you might have day surgery, where you might need consultants out of a hospital environment. That's actually seeing good secular growth, particularly in the US, because of the lower cost to deliver care in those sort of environments. You're trying to get people out of the hospital environment. And that is why you've got pretty reasonable 3 to 4% NOI growth out of that outpatient medical segment. Skilled nursing, we're happy with the exposure they have, but it's not a core for us because there are skilled nursing facilities there. But the skilled nursing piece, you are exposed somewhat to government payments there through Medicaid.
Jason, sorry, Julian. The seniors house is, who's the market there? Are they self-funded or are they, a combination of, all sorts of things?
Largest portion self-funded. So there's no government thing there. Yep. Fortunately, the US doesn't have the huge safety net for that sort of thing, but the typical stay is 2.5 to 3 years. Yep. And dual entry age is 80. So you're toward the higher end of acuity. I mean, Welltower does have some active adult, which is in the 65s, and that your spectrum moves from sort of an amenitized multifamily type through to different skilled nursing at the higher acuity spectrum. But typically, you'll find a resident will sell their home or other assets and fund that 2 to 3 year stay. In terms of the thesis behind it and the history of the investment, pre-COVID, we hadn't invested in these for years because they were dealing with supply. If you look at the chart on the right, it shows you the volume of these units being delivered. So through that 16, 17, 18 period, you had a record number of units being delivered, and you didn't actually have a lot of demand growth, as you can see on the chart on the left. That has really flipped, and net inventory growth as a percentage of stock, which is always an important indicator, is running at about 1.5%. So it's really collapsed, and that's because the cost of building these is more than they've had.
If they can use the rooms again, can't they?
Yep.
Every 2 to 3 years.
That's right. There is one to. Yeah. The challenge will be over the next 15 years, you've got a huge growth in that over 80s population. And this is true in Europe as well, UK, Canada. So there is a real need to build more seniors housing. The demand looks to need about 75,000 units a year, and the peak there is 37. So there will need to be a ramp in construction. It will happen, like the market will respond. You'll see values pick up until it's economic to develop and you'll move into a development cycle. But for the next few years, given supply and given how long it takes to build these facilities, it looks like a pretty good runway for landlords to generate reasonable returns, given those demographics and the supply side. Canada, where we also have some investments, is a little bit further down the road. Its occupancy is around 95%. Development is starting to become economic in certain pockets, and so you'll see that cycle play out there. But in the near term, rents are growing at 5%. Occupancy is growing at 3 to 4% year on year. Margins have been improving because operating expenses are low, and on a 30% margin business, it's a lot of operating leverage, and so you're seeing that sort of 20% growth in cash flow. Now that will moderate clearly as you get towards full occupancy, but still quite a healthy return profile with demographics and underpinned by replacement costs. And you can see how that plays out in terms of earnings. So through that period, 2015 to COVID, a underwhelming earnings profile. And 2017, they did sell a lot of real estate, and this has been part of the management transition. So they've improved the portfolio significantly. Over the last, since 21, they've acquired something like $25 billion worth of real estate. So really improved portfolio. And these are exceptional earnings growth numbers for real estate. And it's the nature of the cash flows. It's pretty unusual to see REITs growing at that level. And that's internal growth, but they're also acquiring a lot. So they'll spend $9 billion this year acquiring real estate. So quite an attractive growth profile.
What did you say the occupancy was at the moment?
So in the US, it's in the mid 80s.
Yeah.
In Canada, it's more in the mid 90s.
Yeah.
And growing fairly strongly. COVID period, they lost 12%. It's a pretty difficult period, as you can imagine, that resident base. Having a time with. Okay. Yep. Moving to Europe. So Merlin is a diversified REIT, and typically for us, we prefer to make the investment decision in a specific property type. So if we want to invest in office, we'll invest in office. If we want to invest in retail, we'll invest in a retail REIT, just executing on one sector. And the reason being, you tend to see those more focused and can deliver better returns over time. At certain points, we can't get the exposure we want in a single sector vehicle, and that's true of Merlin. Merlin is a Spanish REIT with a portfolio focused in Madrid, Barcelona, but the thesis for us has been the movement into data centers. So in Europe, there aren't any listed data center REITs. There was one called Interaction, which we did own, which was privatized by Digital Realty, we invested in. So Merlin is a way to participate in the growth in data centers. And the core of its portfolio is office, retail, and logistics in Spain. Spain as an economy is also actually doing relatively well in Europe, which is somewhat different versus history, but you've got instability in France, the Netherlands. Spain actually is performing pretty well. Retail is doing well. Logistics is a little bit soft, and that's true of logistics in some markets, and that's why, from a portfolio perspective, actually our largest underweight position, we're about 10% underweight logistics. But for us, it's all about the data center investment. And if you look at the bottom charts there, NOI is just net rent. So your rent less your expenses, and it's moving from what is an office-heavy portfolio to be 40% data centers over the next 5 years. And that's all largely pre-funded. They did a large equity raise. And in European context, it's a portfolio which has substantial earnings growth over that period. It's got a leading position in Spanish data center market. And for us, offering pretty attractive returns, and we're comfortable with the core diversified portfolio as well. But it should have pretty meaningful earnings growth over that 2029 period. Now turning to digital realty, so one of the largest positions in the portfolio again, and one of the key data center holdings, of which we only have two. So DLR is a US listed global data center portfolio, and it's also a case of highlighting a company that has really transitioned itself from a strategic and capital perspective, but also benefiting from significant improvement in its underlying markets. So if you look at the chart there. But the history of digital, you can see there from the earnings history through 19 and 23, a bit of a spotty earnings growth history. And if you went before 2019, that was also the case, and we weren't invested in DLR for that reason. And that reflected the fact that even in North America, data centers didn't have pricing power for the better part of a decade. If you looked at rates, your dollar per kilowatt, it had been declining all the way through to about 2018, 19. And for DLR, that meant you had, when deployments came up for renewal, prices were getting cut. It was a pretty underwhelming environment, and that's why we hadn't invested in digital. Obviously, as the market tightened, vacancy is now 2% and has been for several years. In the US, there's been an explosion in demand. Their pricing power, there was a step change. That means that they can actually increase rents, and you've seen that flow through to earnings. So that step change in pricing power and demand has meant not only have they delevered the company, so the balance sheet's in much better shape, but they've now moved into an accelerating earnings profile reflecting the significant increase in rents or rates for data center demand and improving returns from development. But their portfolio is a mix of wholesale and hyperscale and retail co-location. So that simply means retail co-location, to visualize it, can be a single rack in the data center down to one customer. And they might connect to other customers in the data center, might connect to a network, they might have software as a service, they might have cloud in there. The interconnection between customers is quite important in that environment because it reduces the latency, and the data center landlords can also charge for that. So for these companies, it can be 10 to 15% of revenue for those physical cross connects. They also do virtual. The hyperscale and wholesale can be Google, Amazon leasing an entire facility, single tenant, longer term lease. You obviously have some concentration with tenants there, but it is a different beast. And that single tenant has been the significant demand driver because you've had a lot of training applications with these large language models. We're all using ChatGPT and Perplexity and the like, and those models need significant data center capacity to be trained, and that's why you've seen those 6 customers expand their capex to invest in data centers. So if you look across the major tech platforms, Meta, Salesforce, Google, Amazon, etc., they're going to spend about $500 billion this year on capex, predominantly in data center AI infrastructure. It's an extraordinary amount of money. The NVIDIA call, they're talking about $3 to $4 trillion investment by the end of the decade. It's a staggering amount of money when I don't think anyone's got a clear view of what the endpoint is and the actual profitability of that. So there's a massive range of outcomes there. But it is a significant investment cycle. And for us as real estate investors, we don't kid ourselves that we're going to have an edge in the tech and how this plays out. We're trying to be pragmatic about the size of the investment in the portfolio and how we approach it. The data center investments that we have in Digital and Equinix are very much stuck to their core markets. There is capital going into tier 2, tier 3 markets for some of these uses. Whereas a real estate investor, your residual value can be debatable, whether you want to own that stuff long term in Abilene, Texas. So core markets, established platforms, established players sticking to their core markets, and very much focused on the real estate fundamentals for us. What's the supply and demand? What's the pricing power? What's the pre-letting rate for development? Because these can be billion-dollar checks now for a facility. So big numbers. For DLR, for example, they'll spend $3.5 billion in development this year. And those development yields in the US are about 12 to 13%, and they're selling them at 6% cap rates. So extraordinarily profitable at the moment in terms of development. It is a very hot sector, so we are clearly mindful that there is risks around anything that has this degree of enthusiasm. Hence why we think we've got an appropriate exposure to what is clearly a very strong secular demand driver, but obviously we're minded of some of the risks given how much capital is chasing the sector. Something a little bit more basic needs. Most of you probably use self-storage at some time. It's a great little business model, which is clearly getting more airtime in Australia. If you've been following the Storage King and National Storage and Public Storage takeover bids, etc. It is a great cash flow efficient investment. So for other property types like office, you can lose 30+% of your rent in capex and incentives. Office tends to be a pretty horrible investment, except in certain points of the cycle. For something like Big Yellow, no incentives. You'll typically spend 3 to 5% of your rent on maintenance. As you know, if you use them, it's paint here and there, and that's about it. So very cash flow efficient investment. And customers tend to be pretty sticky. You might get a 10 to 15% price increase, but if it's $5, you really can't be bothered moving your stuff. And so they tend to be very sticky cash flows, even though they are short-term contracts. In the UK, this is a great little platform in a market that has been soft. Big Yellow is the leading brand, sort of akin to a Storage King or a Kennards from the Australian brands. The team here, Nick and Jim, have built the business from the ground up really over the last 20 years. I've been covering them since 2010 when I was in the UK on the sell side. It's high quality portfolio, major market focus around central London, great cash flow, excellent balance sheet. The UK has been through a bit of a soft patch in terms of housing market and demand. That's now starting to bottom, and they've got 15% of the portfolio in development. And similar to Australia here, very attractive development yields, close to 9%. And that will really start to drive EPS growth over the next 3 to 5 years. UK market also is one which has been soft, and it has been a drag on our relative returns over the last 12 months plus. That's probably it has been the biggest attractor from our relative performance. We've had 10% of the portfolio in the UK, and the index is 3.5%. But we see good bottom-up value, and actually, as similar to your question earlier, the majority of the exposure to the portfolio is in London. So it's not in the regions. So you tend to have better economic growth, better dynamics. That being said, the Labor government's doing the best to trip over themselves, and that's obviously creating some macro headwinds in the short term. And similar to what the US may go through over the next 3 to 6 months, the UK has been dealing with a pickup in inflation. So inflation's actually running at 3.8 there. Significant base effects around energy for a large part of that. But very cash flow efficient, high quality portfolio, balance sheet's in excellent shape. It's historically cheap. It's a great founder-led business. And over the next 3 to 5 years, you'll see the cash flows grow, not just from a stabilisation in the UK economy over time, but really those development earnings coming through. It's also one where its cost of debt is mark to market, so there's no headwinds there. So as short-term rates go down in the UK, which they are, that's also a support to earnings.
I need to wrap up next.
Yep. Well, it's happy to wrap up, and we can obviously answer any question.
Yeah, if there's any question, that's one section here. That's online.
Just to pull it together, a very concentrated exposure on high quality real estate in major markets around the world. Real estate cycle has bottomed and is now improving as rates become more accommodating and rents continue to grow. You look at the return profile, multiples are at reasonable levels. Earnings growth is accelerating, underpinned by lower supply and high replacement costs. And we think the sector's in a good position to offer diversification based on value, return profile for client portfolios.
Thanks, Julian.
Thanks, Julian.
Thanks, everyone.
As Julian mentioned, fund is available as an ETF, but also as a managed fund. It's on all platforms. It's got the highest research ratings from all of the researchers. and a very strong track record of almost 20 years investing. So thanks again, Julian.
Thanks, Lou. Thanks, everyone. Very much for your day.
Righty, thank you. Everyone online, if you can please jump into the next one, that'd be great, and see you there.